Hey, today is Monday, October 2nd. I'm back with Imran. We're doing our Monday morning meeting again. How are you doing?
I'm good. Another week. Good to see you.
Yeah, good to see you too. The feedback, surprisingly, people like the Monday morning meeting. So we're gonna we'll give the people what they want, and we fire. So here we go. Looking at the S&P, this was the big thing we were talking about yesterday. That we thought that there would be some weakness. There's a bunch of dynamics that we discussed. Kind of go check out that video to look at those dynamics. But the two big things. One, we got the pull down into those 4200s into Friday, and the VIX popped up like it was threatening to really bust out, but we never really got that kind of full expression of vol, right? What do you think about that dynamic as it rests now as we head into this week, the first week of October?
So my theory was the last week that there was that big short strike at 42.10,
Right,
42.15,
the JP
right?
Morgan position.
Yeah, and that was creating some short gamma exposure, right? Between the start, well, that was going to die on Friday. So there was fragility in that if the market had a reason to go down, like yields breaking even higher, whatever it was, and the market started to sell off, that could create a little bit of panic panicky price action. Okay.
Right,
That didn't mean that we were going to get pinned down at that strike. It was just going to create a bit of
right.
panicky price action
It's very
and
fluid.
some sort of vol spike with it, right? And we did get that vol spike. We got to 19 and a half ish on the VIX. But then the idea was, but every dealer kind of knows that this big JP Morgan trade is coming on Friday, where that gamma is going to expire and they're going to sell a fresh big clip of Vega to the street, and we're talking about $10 million of Vega type size, right? So that knowing that that's coming, if I am a dealer, and I used to be a dealer, I used to deal with these sort of flows and these sort of trades all the time, right? If I'm a dealer and I know someone's going to sell $10 million of Vega to the street on Friday, and it's a systematic trade and it's telegraphed and it's definitely happening, whatever happens, I'm going to use any vol spike to get myself a bit short vol because I'm going to have the inventory to then buy the vol back on the bid side when the seller comes,
Mhm.
right? So because of that psychology and because of the idea that you've got this massive flow that is well telegraphed at the end of the week, my idea was that if vol did spike midweek, it would get sold into, right? And it wouldn't last long, right? Because people in their right mind on the dealer community would say, okay, let's smash some vol out here. And we know we're going to get given it back on Friday. So there's good risk reward in doing that, basically. So that was the logic. And that seemed to be what happened in the VIX last week.
Yeah.
And I also said that this week now just started. I think we might still retest those lows that we made last week. But if we retest those lows last week and we don't see vol spike in the same way, that tells us the street is less short now, that the street is more comfortable with the Vega that it's sitting on. And actually, more medium term, that gives us the springboard to rally off, basically. Right. So that's my new revised scenario that we did play out as we thought. And now any weakness into this week, provided fixed strike vol doesn't rally, provided the VIX doesn't make a new high from what it got to last week, should be a signal to say, okay, time to gear up for the move higher into year end.
Yeah, I like a lot of that logic. I also would add that the JP Morgan position gets just so much attention at this point, and there's a lot of validity to it. A lot of the mechanics you just mentioned. There's a whole lot of other interest at that 4,200 strike. We calculate around $100 billion of total put deltas across S&P, Nasdaq, and Russell. So there was not only that position that was in play. There was a bunch of other puts kind of in that same vicinity. Some of those could be related to the trade as well. Just people trying to play it and whatever it may be. And so some of that has come off. And I agree with you that we're in this area and we're looking for a springboard rally. I would argue a little bit earlier. I would just say that, and this is part of the Monday morning meeting, if we could break that SPY 430 area, that is my signal that we're set up to rally. In that maybe we pull forward kind of the Vanna that's built up and we're in this negative gamma environment. So we could run pretty sharply. I still think the 4,400 area is kind of the easy upside target in that scenario. And to your point, uh, you know, we could very well remain kind of stuck in the mud here and things could remain a little bit chippy. But if we break that 430 SPY area, which is roughly 4320 in the S&P, then I think that those dynamics will kick in and we could get a pretty sharp short covering rally. And that's the setup that I am favoring. I do think personally that this 4,200 area is going to be a possibly a downside limit into October OPEX. So we'll see those play out. I want to pivot quickly to you brought up two names that were quite interesting. UNH last week, just kind of check the tape. UNH did close down about 1%, I believe, from your call there. And so that stock is kind of working in the right direction. You had recommended, I believe, some short term puts. And the second one, which I thought was very interesting for this week, was Google. Despite all the weakness last week, Google was up. You made a longer term call on Google. I like that call. It did close up on the week while the rest of the market was down. They got a lot of AI stuff cooking. And as one of the big seven, if the market does rally, I do think that this could have some asymmetric upside to it, as is part of the big seven and the stocks that seem to gather a lot of the strength. Um, let's pivot now to the calls for this upcoming week. This is your single stock strategy compass. You want to walk us through the two tickers that you brought up here and
Yeah,
the
yeah.
setup that you see for this week, again, Monday, October 2nd.
So firstly, I will say that none of the names on the compass were like really far away
Mm,
from the center, right? So
yeah,
generally, when they're not super far away, then the conviction levels aren't going to be as
right.
high. Okay.
But it's the Monday
I,
morning meeting, so you got to give us
I
something.
got to say something. Exactly. That you got to give the people what they want, right? Now I think JP Morgan stock, it's been consolidating. It's had a bit of a move down on Friday. It's hovering above this 140 area of support, quite a big area of support now, down at 140. We've got earnings next Friday, so
Mm,
they're obviously the first big bank to report, or they're usually one of the first. So I just think that the odds are this week the stock doesn't make new lows this week, right? If it's going to make new lows, probably going to be post earnings, and therefore selling a bit of downside, kind of underwriting the stock for this Friday looks okay here, right? Because realized vol's been quite low in the mid teens, implied vol's still in the 20s, so you're getting a bit of juice by selling those puts. So the stock's trading, we're stock trading like 143 ish,
yep.
and you can sell the 141 puts, nick a little bit of premium out of them between now and Friday, right? So that would be my kind of YOLO trade.
Right.
The YOLO
And
trades are
key
the
to
high
note for this, this is a pre-earnings put that you're selling, not post.
pre-earnings, yeah. So the earnings date is the 13th, which is next
Yep.
Friday, but I'd sell the 6th, which is this Friday, because I'm basically saying that the stock doesn't need to do anything much this week,
Yeah.
right?
Yeah.
And it already got whacked on Friday as well,
And
like 2%.
and critical on that positioning before earnings is that the vol is probably going to hold up for any expiration past equal to or past that earnings date, right? And so that is a critical
Exactly. So
distinction.
yeah, so because if you sold a put expiring on next Friday or a day after that, the risk that you're taking is you're not going to earn any time decay between now
Right.
and then, because the market's going to imply a 3% move on earnings, whatever. And often what happens with earning moves is as you get close to the event, the implied earnings move actually gets bigger because
Right.
people get more and more interested and more excited about the event. So what happens is that the time decay of the option doesn't ever manifest as any time decay, and the option doesn't drop in premium the way it should do. So you're always taking a bit of a risk by selling options that contain a big jump event, like an earnings, because they just don't decay well, right? Sometimes when the vol's crazy high on them and their already implied move is already massive, like Nvidia, for example, last earnings, the implied move got to 10% or whatever it was.
Someday.
Then okay, it will still decay. But I think for a stock like JP, where the implied moves 3% and it actually sometimes does bigger than that on earnings, I don't see a lot of value in selling an option that contains the actual earnings move.
Right. So this is the term structure for JP Morgan. Here's the six, which is the option that you're looking at. And you can see this big spike in implied due to that earnings release. So there's the kind of the visual representation of what you were just discussing.
Yeah, yeah.
Okay, turning now. Second one is Amazon. This is the name that I sort of flagged in my data as well. So what's your look on Amazon? I know you preface this whole thing by saying there's not any like super juicy setups, but what do you kind of see in Amazon that's interesting to you?
So yeah, I mean, you can see that it's carved out, a correction, quite a meaningful one, back down to this 120,
Mm,
127 area, I believe, right? There's quite a lot of volume. That volume shelf there's quite a lot of volume support there as well. It's at the lower Bollinger Band. So these are all reasons why, tactically you would get a bit more bullish. Now I'm looking in general for the Nasdaq to rally into year end. I think these mega cap tech names are going to be the names that people want to own again
mhm.
when the market finally does kick back into gear. I put out something in my daily note this week saying that, or today, not this week, but saying that the valuations, when you adjust the valuations for earnings growth, so you look at the PEG ratio, they look quite cheap in mega cap tech names, look quite cheap relative to the median S&P name, right?
Mm.
So if that's the sort of thing that's going to drive people into those names for a year-end performance chase, then yeah, Amazon's going to participate basically, right? So I think owning December calls in Amazon, I'd go to December just because the curve is inverted, so the front end vols are higher. The 1 month vols contain earnings at the end of the October, so push yourself out a bit to like 3 months. So not only do you get a bit of a vol discount by going out to 3 months, you also get much more time for the view to actually play out, right? So I think I'm not going to buy the earnings volatility, but owning December calls in general, any single stock calls that I'm buying for a year end rally, I'm generally parking them in December right now, which is what I did with Google last week with that suggestion, and the same suggestion for Amazon. I think December calls are probably the way forward.
I like that idea too, and we had picked up Amazon on some of our new scanners that we're working on because I like this 125 level, which you had just kind of mentioned that that's right in here. This is where a put wall is. The name, as you mentioned before, has really been dragged lower. I think that this has boosted the implied volatility of the name a little bit. And really, what the key here is that I too think a rally is setting up. And so, if you want to play upside, you got to stick with the big seven in this scenario, the higher for longer scenario. If we do rally, these are the names that are going to do better. And I would argue too that if the market is weak, these names should probably hold up better as well, right? So maybe there's a little bit less relative pain depending on how you want to express your upside idea. So I
Another way of expressing that view for those who don't want to be completely one leg simple trades
yeah, please fire away.
is you could own the December calls in Amazon and you could sell some October or end of October, whatever captures the earnings
Yeah,
premium,
it'll
you
be
could
the
sell.
11/3 is the earnings.
Okay, so yeah, so they sell some calls on that date, and because they're going to trade quite expensive,
Mhm,
basically, right? Yeah, so you actually have a call calendar on, and you make sure the net delta of the position is still positive because you're bullish
mhm.
the stock. But that can actually save you a reasonable amount of money in terms of the premium that you're spending. That might be a smart way to play a move up, but take advantage of the shape of the surface. Yeah.
Yeah, I like that, I like that idea a lot, reducing that net cost. I actually think if you do think there will be a rally into October OPEX, which is turning out to be a decent size expiration, I do think some of these October expiration calls, if you could find them cheap, or if you can put on some kind of a call fly to help reduce your costs, that kind of thing, could be interesting. Or even selling something like NASDAQ or Spider calls as a way to fund these Amazon calls, because I think that in an upside scenario, Amazon will really outperform. So that may give you um, a bit of extra juice. And I think Amazon could rally pretty sharply with 140 as kind of like my top level. So if we do pop, I do think we could get a pretty meaningful move up into this 135 to 140 area, based on how all of the positions here are laid out. So you can see that there's a lot of call positions. Again, kind of this 140 call wall is really that upside level that we're watching into that October OPEX. So again, a lot is predicated on the fact that we could get a rally in the macro market sort of sentiment and move here. And I think that's, you know, there's a little bit of sort of path dependency between you and me, I think, on when that rally could happen here. But I do think that this is a great time. This is why you like to own calls, right? To give you that upside optionality.
Yep.
All right. So that, Imran, we're going to wrap this one up as we keep these Monday morning meetings about 15 minutes.
Yep. Sounds
If
good.
people want to reach out to you, what is the best way to do that so they can make sure that they're getting your juiciest calls?
Okay, options underscore insight is my Twitter handle. So we obviously put loads of stuff on there throughout the week. But if you want to talk to us directly and look into our actual products and our services, options-insight.com. Come and check us out there. We do offer a free month to everything we do. So you can really kick the tires and get a sense for whether we can help your process and help you make money. That's the goal.
Awesome. I'm at SpotGamma on Twitter. You can reach us at spotgamma.com. Also, there's a little QR code in the top left there. That's the hedge featuring Imran. It's our options academy. It takes you all the way through what's a call and put, all the way up into delta hedging like a pro, right? With that, Imran, we will end it up and we'll see you next week.
See you next week, bud. Bye.